Before creating an investment portfolio, it's important to understand how to navigate the tax system to make different income generating assets work for you. Taxes can sometimes limit the amount of earnings we have access to. Fortunately, different sources of income are taxed in different ways. Three common sources of income you may receive as an income investor are interest, dividends, and capital gains. Interest. Interest is payments you get from fixed income products like bonds, treasury bills, and guaranteed investment certificates, or GICs. Out of the three income sources, it's the most tax heavy. In Canada, 100% of it is taxable whether it's reinvested or not. There are also no tax credits available for interest-based income specifically. And if you're investing in foreign income-bearing assets, you may be subject to an additional withholding tax from that country. On the plus side, you may be eligible for a foreign tax credit in that case. Dividends. Dividends is income you get from some Canadian equities and ETFs. Some larger corporations pay out dividends using their after-tax dollars as a reward to shareholders. These are called eligible dividends, and they're taxed at much lower rates than interest-based income. There are also tax credits available for this income that can make dividends highly tax efficient. Now, there's a wrinkle to this when it comes to dividends paid by foreign companies. These dividends don't qualify for Canada's dividend tax credit. Instead, they're fully taxable just like interest income. Foreign dividends may also be subject to withholding tax from whichever country the company is domiciled in, but here too, you may be able to claim a foreign tax credit. Capital gains. A capital gain is the amount an investment's value rises from the time it is bought from the time it is sold. Anytime you sell a capital asset for more than what you purchased it for, be it a stock, bond, real estate investment trust, or other capital asset, you will need to pay a capital gain tax. For both Canadian and US-based capital gains, currently 50% of the dollar amount you realize must be added to your total income. From there, you'll be taxed at whatever tax bracket you fall under. Of course, not every investment pays off. Sometimes you'll sell a capital asset for less than what you bought it. When that happens, you'll report a capital loss. And there's a silver lining. You can use potential capital losses to offset capital gains each fiscal year. And if you still have leftover losses, you can retroactively apply them for up to 3 years for a refund or carry them forward to future years' capital gains. You might have heard of investors selling unprofitable investments at the end of the year. Now you know why. If it sounds like a lot of legwork to track capital gains and losses, that's because it can be. Thankfully, most financial institutions provide annual summaries and tax documents to help you keep track. As a result, many Canadian investors choose to shelter their interest-based investments in registered retirement savings plan, a registered education savings plan, or a tax-free savings account. With RRSPs and RESPs, you don't pay tax until you withdraw the funds, which ideally occurs at a time when your tax rate is low, like at retirement or when you're a student. With TFSAs, as of 2022, Canadians who are 18 as of 2009 and have never contributed to a TFSA before may contribute up to $81,500. Any income earned within a TFSA from that initial investment is tax-free in Canada. Because investments that pay dividends and capital gains often provide a greater return than interest-bearing assets, it's often more beneficial to use non-registered accounts for them. That's because when the funds are withdrawn from a non-registered account, the characteristic of income as a dividend or capital gain is retained, along with the associated tax benefits, which is not the case when that type of income is earned in an RRSP or RESP. Having said all this, tax benefits should always be balanced against sound investment decisions. If you're unsure or would like more information, please speak with a tax specialist. Okay, so now that you're up to speed on how to make the most of different sources of income, head over to our video on common income products for a closer look at T-bills, GICs, bonds, REITs, and dividend stocks. To learn more about the benefits of registered accounts, see our courses, Account Types, Registered Plans, and Tax Planning Strategies for Canadian Self-Directed Investors. Have more questions about income investing? See our schedule of upcoming webinars and masterclasses for instructor-led content and insight from industry guest speakers.